What's up, everybody? Welcome to the March 30, 2026 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWealth. We were on a little bit of a hiatus last week. I went to the Reservation Economic Summit, where we have a lot of Native American tribes, organizations, and businesses that are surrounded with building that community up. I'll get together in Vegas and learn from some best practices and those kinds of things. So really engaging, honestly, very, very big. 3,000, I think, in attendance on Monday, and I think 5,000 registered. So excellent. It was great to get a chance to meet some people in person that I'd been talking to and to learn some things. But now we're going to get right back into those hot button market issues. So let's get started. First off, I've been a bit of a broken record on this. I was actually looking at our history for the past 3 or 4 weeks of doing these, and I think oil was on the top of every one of them. And to be honest with you, I'm not going to change much. I'm sorry. It's a little bit of a broken record right now in the effect of stocks, oil, and war. That's all anybody's talking about, really. And that's what moves stocks up and down at this point right now. Now, I'll get into, when I talk about point 3, some of the differentials that we're starting to see that are getting interesting. But the overall market on a day-to-day swing tends to be going with what is going on in Iran. How long are we going to be there? What's the impact on oil? How aggressively is oil moving, whether it's up or down? It just tends to be very volatile right now. And stocks, frankly, are moving on that more than really anything else. So while I apologize for sounding like a bit of a broken record, when we do talk about what's happening in the weekly update, we want to give you those hot button issues. Right now, it's just front and center, and I don't know when this is going to end. So we may continue to talk about it, but frankly, we're going to pivot the conversation a little bit into more portfolio actions, because right now, similar to everyone else, we've kind of got caught up in the day-to-day fluctuation. Now, we have made not one trade on this activity lately, nor do we see ourselves making especially short-term trades on what we think is going to happen with regard to oil, with regard to the war and all that stuff. It's a prediction market that's very, very difficult to do, and we don't really entertain ourselves in that. What we will make decisions on and what we will make portfolio actions upon is, are things getting irrational in one way or another? And we are starting to see just a little bit of that. You know, the NASDAQ just entered correction territory. It's down 10% plus. The S&P is not quite there yet. Small caps have fallen into correction territory. But within those, as I said before, in point 3, there is some pretty decent damage from some big companies that we believe are still pretty valuable. And subsequently, we've had pretty good performance from some of the companies we've owned, and then some of the companies we don't own, but that we watch, that may require a bit of a pivot here. So we're going to be paying attention to that, and I'll talk about that more in a minute. Turning to number 2 is the Fed probability. Is what I put is 1 month difference, but what a difference a month makes. So if you look at Fed probabilities back before, I would say end of February, let's just use the end of February, there was a less than 20% chance that we were going to have the same rates that at the year end that we have right now for the Fed funds rate. That was the probability, is there was a very low probability of staying the same. There were, some had 2 cuts, some had 1 cut, some even had as many as 3 cuts built in. But it was predominantly, at the end of February, still listed as the most likely scenario was at least 1 cut and up to 3 cuts. Those were the most likely scenarios, and staying put was among the lower scenarios. Turning now, you look at the end of this month, I just looked this morning, and you have by far the highest probability of staying put. That's what the market believes now, because inflation, and this is what we've been talking about basically since year end, is inflation is not controlled right now. And it is difficult for the Fed, as governors, as the chairman, to really start to cut rates in an area where economic growth is certainly slowing, but it isn't in contraction territory yet. And you have inflation that not only on its core is still above their targeted levels, but now you have instances of the things in headline, the oil and food prices, being affected by energy swings and high volatility, which usually tends to be at least short-term inflationary, right? If a business all of a sudden has one of their input costs, shipping, getting much more expensive because oil is much more expensive, well, guess what? Those prices get passed through. So that is interesting in and of itself, is that we've really changed scope. Now, what I'll tell you is that fluctuates over a longer period of time, right? As they were wrong earlier in the year. Are they right now? Who knows? But it is more likely, in our opinion, and we've been saying this, is that, until there's some evidence that inflation is under control, the Fed really hesitates in making those movements. We wrote a piece on it a couple of weeks ago with regard to that same thing. If you look at the long-term trend of inflation, there's some pockets of differential. If you just kind of take a decade by decade, or 10 to 15 year cycles and things like that, you see some behavioral differential, but inflation and the Fed funds rate tends to flow in the same direction. So I still think that's the case now. I don't see them making any activity until they're forced out of it, either relaxing because inflation is coming down, or economic trends are getting bad enough that it forces them to make a movement. Now, turning to number 3, the year-to-date bear market. So I did, I just kind of looked year-to-date, just wanted to see what was working, what was not in the stock market. I do that honestly all the time. And the bear markets, a couple of them were interesting to me, is that Microsoft, Meta, American Express, all down 20% year-to-date. Which is pretty substantial. I mean, a substantial decline in, you're in bear territory if you're 20% down from your high. And all 3 of those stocks are, and many, many software stocks are still in that. And we've talked about this a few times, but many of those software stocks are still in the 25, 30% decline range, where they've had pretty substantially negative performance. But on the other side, we have a lot of 10% plus stocks. Walmart, LMT, Exxon, J&J, Lockheed Martin for LMT. I sometimes get in the symbol phone. LMT is Lockheed Martin, J&J is Johnson & Johnson. But those are up 10% year to date. So if you just look at those 2 data points, you have certain stocks that are up 10%, some stocks in bear territory. That's a 30% differential in performance year to date. That's what I was saying before, is that stocks are down year to date, no question, pretty much across the board. But you have some that have worked pretty decently well and some that have really been taken to the woodshed. And that's where we get interested on our side from an individual stock perspective in saying, what can we take advantage of? Is 30% enough? Because sometimes going into these changes, LMT may have been very cheap and Microsoft may have been very expensive, and this just gets them to rationality. That sometimes happens, but that's what we tend to analyze here, is when you start to see these significant movements, has it been overdone to where we think we could take advantage of it, both on selling things that have worked well for us and buying things that we don't own or don't own enough of that we think now we can take advantage of maybe a potential rebound in the future. So when we do our Indy stock portfolio, which is our individual stock portfolio, that's the kind of behaviors that we're looking at. We don't tend to take a lot of aggressive stances on day-to-day trading. We want to see where those big differentials are that we can take advantage of over longer periods of time with companies that we actually believe in. That's always a big thing on our side, is that I believe in investing in quality companies. I believe you can really maximize that over a longer period of time when you can find quality companies trading at discount prices. Turning to number 4, I talked about at the beginning of this that I was at the Reservation Economics Summit and was really energized by it. I thought there was a lot of interesting stuff, but more importantly, I thought there was a lot of interesting stuff that may not be getting communicated in a fashion that helps those people who need to make decisions in tribal governments, in tribal offices, in foundations, these kinds of things. So along that, I mean, I had this plan, to be completely honest, well before the Reservation Economics Summit. But it just solidified that we are going to be launching a podcast called IndiNations. So it's coming very soon, probably as early as this week, where we're going to talk about those issues. And we're going to try to break it down in the same fashion that I break down the markets here in our IndiView podcast. The IndiNations podcast will be focused much more on tribal issues, tribal finance issues out there, and trying to explain them in a layman's way and actionable moves that people can take to benefit from programs out there, to understand how to develop investment policy statements. We have a lot of area we can cover under that umbrella that I think are going to be valuable to, hopefully, to the listeners and hopefully to decision makers in Native American governments and tribal organizations. So keep in mind for that. It'll be coming, like I said, I think it's going to come this week. And we're really excited about it. And we think there's a real opportunity to discuss that with you all. So that is it for the IndiView Weekly Market Update. Tune in next week where we'll have our next hot button topics. Until then, thank you very much and take care.